Hi everybody, and welcome back to this second video on IFRS 17 Lecture 2, How Profit Emerges. So in the first one we just set up a kind of a toy example by thinking about a term assurance and what the cash flow profile could be. So in that example, which I haven't got written down here anymore, we had an example where the new business strain was £300 for a particular policy, so 300 going out or a 300 loss right at the start, and then in subsequent years we had a positive cash flow or a profit of £150 for like each year for the next 4 years. Okay, what we're going to do now is start doing the same example but using IFRS 17 type logic. So let's give ourselves a title. Term assurances for accountants under IFRS, IFRS 17. Okay, so first point is that IFRS 17 handles emergence of profit differently. It sets up a, in inverted commas, CSM or contractual service margin liability and releases it gradually over time. So when this liability is released, the money that's coming out of it goes into your profit and loss account and emerges as profit. Now from lecture 1 you might remember the initial CSM formula, and we'll just restate it here. So the initial CSM formula is the maximum of expected present value of premiums minus expected present value of expenses minus expected present value of claims or benefits, if you prefer, minus RA, which was the risk adjustment thing that that's part of the kind of IFRS 17 construction. So the maximum of that and 0. Okay. Let's fill in the above formula using star and assume that the risk adjustment is equal to 0. So star is what I labelled all those cash flows last time. So the minus 300 and then the plus 150, plus 150, plus 150 and plus 150. And we're also going to assume that this RA term is 0 just for simplicity. So what does that give us? It gives us an initial CSM that's equal to minus 300 plus 150 plus 150 plus 150 and then plus one more 150. So this is equal to plus my currency is pounds, so plus 300 pounds. Okay. So this is nothing to do with profit yet, almost. This is just the amount of CSM liability that goes into the balance sheet for a particular product, well, a single contract in this case, at time 0. So what's the kind of logic as to how this is treated over time? This CSM is supposed to be released as profit over time in a way that reflects, and I'll put it in inverted commas, transfer of services, end inverted commas, to policy holders. And we'll just use a PHs as an acronym for that in a second. So this this transfer of services thing, the idea is that profit should emerge as we are providing stuff to the policyholder. So on average, I might expect there to be so many policies in force for the first year, and I might expect to pay out so much in claims in the first year. And so I, in a sense, the paying out of the claims is the transfer of services to policyholders. The presence of the contract being in force for a time is, in a sense, a transfer of services to the policyholder. And you could imagine there being, I don't know, say more policies in force at the start and less policies in force at the end. So you could weight the transfer of services in that situation as more toward the start of a contract than toward the end of a contract. So this whole kind of paragraph of logic would suggest that really more profit should be attributed earlier on in the contract to later on in the contract. We're going to use an example where we're going to assume that the transfer of services is pretty even in each year of our particular little contract. But you could get a situation where it is quite different. So this is kind of a general principle for how the CSM is supposed to be released. I should say that, let's put in some red here. you will also see the term coverage units in the regulations. So this is a way of just mathematically turning this kind of concept here into something that you can apply in terms of figuring out how this CSM releases over time. I'm not going to say any more about that just now. I'm just going to kind of keep going with our example. So, or should we take a break? In fact, maybe this is quite a good time to just to take a break and then just kind of come back to the detail in the next video. So let's just kind of put in a kind of a sub-heading break here. Okay, see you in the next one.